On today's show, the Dow and S&P 500 both make record closes. Are we about to enter Trade War 2.0? What happened to the economy after Trade War 1.0? And will small cap seasonality take us to the promised land? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks rose on Tuesday as they shrugged off Donald Trump's threat to impose new tariffs on China, Canada, and Mexico, with two major indices, the Dow and the S&P 500, securing fresh record highs, and the FOMC minutes giving us more certainty for the road ahead. Today was another day of broad-based gains, with mega caps participating too, including Nvidia up 0.7%, but that sentiment did not flow into the rest of semiconductors, and that had to do with the tariff situation. We'll talk about why and how in a second, but we saw Microsoft participate, same with Apple, infrastructure tech, Amazon, Google, Meta, Eli Lilly up 4% as well. Tesla did not participate, but after a 40% rally in 2 weeks. Also, broad-based manufacturers saw a bit of a pullback today, GM and Ford, and again, that has to do with the tariff situation. We'll talk about that in aggregate. But all in all, it actually was a very bullish day. Only two sectors were in the red, the material sector as well as energy sector, and that mostly had to do with commodity prices, the tariff situation, international trade. Everything else was really bullish. Yes, we did see some underperformance here in XLF, XLI, XLY, relatively speaking to the S&P 500, which returned 0.55% today, and that was led higher by healthcare, utilities, real estate, and technology, all up more than 0.5%. But the icing on the cake today was really just utilities, up 1.58%. Very strong trade. But all in all, out of the 11 sectors, 9 were positive. The S&P 500 was positive. If you were in a broad-based portfolio, if you were in the S&P 500, the NASDAQ 100, you did really well today. Where you did see some losses was small caps and potentially mid caps as well. Large cap growth and large cap core was the icing on the cake. They were positive handily today, but we saw underperformance in mid cap growth, core value across the factor and size spectrum. In mid caps and smalls, we saw stark underperformance, particularly here in the value segment. And there was a whole bunch of factors there. Just the markets taking risk off after the tariff situation that Trump went on in the morning, going on about tariffs. And, investors just wanted to move out of these riskier asset classes, lower quality into higher quality. And that's somewhat the rotation we saw today. And that's why we saw mega caps outperform, large caps outperform, and these smaller names underperform, particularly in the core and value segment. This is the lowest quality segment of the market. And that's why they underperform today, because, that risk is there and that risk needs to be discounted. All in all, we saw a pullback in broadly risky assets. We saw Bitcoin pull back from its highs from the 95,000 mark right here to the 90,000 mark. And the market definitely rotating into larger cap names as well as defensives. We saw that right here with utilities, healthcare at the top as well, real estate, somewhat of a defensive sector, and large caps outperforming. So we did see a little bit of a defensive rotation, but we also had some major earnings movers. Now, this is a bit concerning. Best Buy reported their earnings and there was nothing to love. Domestic comparable sales fell 2.8% on top of a 7.3% decline for the year so far. Management gave a full year sales warning, hinting at a lackluster start to the holiday shopping season. Not good. Almost 300 million year-on-year increase in inventory against the backdrop of lower sales. You don't like to see that. Comparable sales in appliances and entertainment plunged 14.7% and 18.8% respectively. And to be honest, I can't really say this report is surprising given the discretionary category weakness we've seen in earnings reports. We've seen in earnings reports this month from Target, Home Depot, Lowe's, but the declines for Best Buy suggest we will have a slog of a holiday season. So we'll see how that turns out. out. Another market mover, Amgen, this really did drag the Dow Jones lower today. Despite the Dow Jones going out and putting out a record close like the S&P 500, this was a drag at one point down nearly 12%, down 5% for the day, or 5.2% for the day. And pretty much the company came out and reported a 20% weight loss from the drug MariTide in its patients after 52 weeks in phase 2. This is a GLP-1 equivalent to what Eli Lilly and Novo Nordisk have. Now, a 20% weight loss is actually about average. Eli Lilly and Novo see weight loss between 14 and 24%, so it's right smack bang in the middle. The data was categorized as inline, but apparently inline data is not good enough in this market anymore, and that's why the stock was down 12%. And pretty much this confirms that Amgen won't have an edge over drug companies like Eli Lilly or Novo. It's pretty much going to be another GLP-1 participant, and it's likely to have the same economic advantages and economic moat as these first movers. Nonetheless, what really did move markets today was Trump's tariff threats. Trump pledged late Monday to slap big tariffs on the US biggest trading partners, Mexico, Canada, as well as China. Donald Trump said he would do this in his first day in office, and as a result, European car makers' stock fell on the heels of this America First push. Nissan fell, Honda fell, which both have auto plants in Mexico. Ford also fell. The US dollar rallied, but the Canadian dollar and Mexico peso fell. And guys, when you look at tariff threats and what's coming, I think we are going to see a trade war 2.0. So it's more important than ever to focus on what you own, particularly in your stock portfolio. A rising tide won't lift all boats in 2025. And the divergences like we've seen, financials outperforming and only a select mega cap names outperforming, that will probably continue into 2024. Companies that can handle headwinds like banks and capital markets, very attractive. They're benefiting from cyclicality, deregulation, and a steeper yield curve, and are sort of immune to the tariff situation we're seeing. So that's definitely the place you want to be in 2025. I think you also want to be in high quality companies with strong free cash flow, growing margins, and solid returns on equity. Those are key, particularly if you're going down the spectrum in size, mid caps and small caps. You really want to look for quality names. It's why I've emphasized small cap quality over the Russell 2000. And by staying selective, you can navigate rising rates, a stronger dollar, tariffs, and set yourself up for success. So next year is going to be a very hard year to make money, guys. It's not going to be like 2023. It's not going to be like 2024. It's going to be very hard to make money. There's a lot of moving parts. So you got to be selective and subscribe, because we will be making money on this channel. And then when we actually look at what was the result of Trump's tariffs, the global market was actually very red. China, Southeast Asia, the Australian market, Europe. Now, for some reason, South America was very, very green. Canada was very red. And the US was really the only green market, with a couple of other geographies. But that was about it. Along with all of the news we got today, we also had economic data, and we got consumer confidence, which printed in line. American consumers continue to feel a little bit more upbeat on the US economy. Maybe this has to do with the Trump victory. November's increase was mainly driven by a more positive consumer assessment of the present situation, particularly the labor market compared to October, and consumers were also substantially more optimistic about future job availability, which reached its highest level in almost 3 years. Jobs plentiful increased and jobs hard to get decreased. This was in contrast to new home sales, which missed by a wide margin. Sales of new single-family homes plummeted in October to the lowest level in 2 years, guys, printing 610,000 versus a forecast of 725,000. And this largely has to do with the massive increase in rates we've seen since the Fed's first rate cut. Today, we also got the FOMC minutes, and I'm not going to go through everything. I'm just going to go through the key point that I saw in the FOMC minutes. And pretty much the big thing to take away from the FOMC minutes, the market committee prefer a gradual pace of interest rate cuts now if the economy remains on solid footing. So if we continue to print the solid economic data we have in the last 12 to 6 months, we're going to see a slower pace of rate cuts compared to what the market expected. And I'm going to quote, participants anticipated that if the data came in about as expected, with inflation continuing to move down sustainably to 2% and the economy remaining near maximum employment, it would likely be appropriate to move gradually towards a more neutral stance stance of policy over time, the minutes read. Some officials noted that a resurgence in inflation, which has remained sticky, could force the central bank to pause its easing cycle. And all in all, this is telling us we probably are going into a slower rate cutting cycle because of the strong US economy we have right now. And for everything we've seen today, guys, market breadth is still looking very, very solid from the 5-day to the 200-day. This is solid, and any dips we do get in the market, right, you just want to buy those dips because right now the trend is up. You don't want to be a contrarian in the market right now. You don't want to get in front of this. You don't want to fight the trend. Get on board. We're going to roll all the way up until mid-January, up until the inauguration. Then we can talk about material downside. But for now, the trend is higher. The market is weathering all of these storms. All of the bad news just seems to be brushed away. We're climbing the wall of worry, and we're simply moving onward and upward. We just had a record close in the Dow Jones, the S&P 500, and do expect that to continue into year end, into the start of 2025. Now, looking at the charts, guys, the S&P 500 and Nasdaq 100 both up 0.57%. We saw small caps, mid caps underperform, the large caps down 0.73%, but we're seeing some bullish momentum here in the after hours. Mid caps were down 0.44%, SP 600 profitable, small caps down 0.89%. So a very mixed day in equities. Really was just a day for larger cap names. Look at the RSP, pretty much flat, up 0.01%, but we're seeing a lot of bullish momentum here in the after hours, guys. So all in all, it happens when stocks go up, they have to come down, and we're seeing a bit of a pullback here. Completely normal, nothing to be concerned about. The trend is clearly still to the upside. We are seeing some interesting developments. The yield curve continues to steepen. The 2-year yield pulled back. The 10-year yield rose, as well as the 30-year yield, which was pretty much flat. The dollar was also flat. And for all of the news we saw with the tariffs and everything today, a flat dollar probably indicates that we are at the top end of the range, particularly if I have to zoom out. We've got some trend lines right here, and you can see that this 107 area is the top of the range here for the dollar. We hit this a couple of times, and then we actually did pull back. So we probably do see a little bit of a pullback in the dollar. That's going to coincide with a pullback in yields, and that's going to support equities into the end of the year. We also saw gold and silver rally today, up 0.55% and 0.28%. Bitcoin pulled back, crude pulled back as well. Bonds fell as a result because the 10-year yield was up 0.44%. All in all, a very mixed day across the board, and really the place to be was large cap and quality names. But let's look at the S&P 500. So some very, very interesting developments. Let's just actually zoom in. That's a new all-time record closing high. The core resistance moved up to the 60.55 area. That means there's more upside for us to go into the end of the week. The gamma flip also moved up, and the put support. But the most interesting development was actually on the Nasdaq 100. The put support moved up really, really close to the gamma flip. And when this normally happens, this often is a very, very strong support zone where we can actually buy the dip and move higher. So that's telling us that the options market is seeing higher price action and not much downside risk for these mega cap names. Maybe it has to do with that flight to quality, flight to defensives we saw today after the tariff news. But the RSP, you can see the broader market did take it on the chin. We do have some pretty ugly candles up here, shooting star dojis. Often that does mean downside, but candle chart patterns are not a reason to sell or buy. They're just one tool in your toolbox. Nonetheless, that's pretty much an all-time high here for the RSP. Things are very, very strong for this name. And look at that. That's a very, very strong chart if you ask me. When we look down the line, down the size segment, looking at the Russell 2000, guys, all of these indices are also in positive gamma. The S&P 500, the Nasdaq 100, and the Russell 2000. Yes, we have seen a little bit of a pullback, but again, it looks very, very healthy when you ask me. We're in positive gamma. There's a little bit of upside to the core resistance, and this is just telling us that we just want to remain bullish. You don't want to be a contrarian. You want to be a bull in this market. Put your money to work, and you're going to see higher price action. I think we see 3 or 4% more upside into the end of the year for the Russell 2000, maybe 1 or 2% in the S&P 500, maybe 2 or 3% in the Nasdaq 100. But I do think we're going higher into the end of the year. You don't want to fight this trend. You don't want to jump in front of this. You just want to ride the trend. And I love that quote I just said. You don't want to be a contrarian, right? Don't try and bottom tick stocks. Look at what's working right now and buy those, right? For example, something like PayPal. This is a stock that's just working. Look at it year to date. That is a stock that's simply working. Higher highs, higher lows, new 52-week highs, a little bit of a pullback here, and we probably go higher. We probably are going to touch the $90 mark before the end of the year. Look at these names that are working. Look at Paycom Holdings. You just want to buy names that are working right now. Paycom Holdings. This is a name that's working. You want to get onto this, right? That's a new 52-week high, great earnings. You want to be in a name like this. This is a name that's working. You want to look at something like the RTY. The RTY is a name that's working. That's a new 52-week high right there. And and we're very close to all-time highs, 0.5% away from all-time highs. This is a name that's working. Higher highs, higher lows, new all-time highs. This is something you want to be in. Where you don't want to be in is a name like Estee Lauder right now. Number one, I do think very long-term, this is a stock that's going to do very, very well, but you just don't want to be in a name like this. You see this massive gap you saw right here? That's because of the terrible earnings we saw. And yes, we are seeing a bottoming out, but it's definitely not performing like some of these other names, like PayPal, like the RTY. You don't want to be in a name like maybe 5, 10 years down the track. Sure, the stock will do very, very well. But I'm talking from now into the middle of January, you don't want to be in a name like this. Look at PayPal, look at Paycom, look at some of the mega caps that have done very, very well. Maybe something like Amazon, look at Tesla. These are names that are simply working and you just want to buy pullbacks into the end of the year. Look at Tesla. That's a name that's working. Okay, we are seeing a little bit of consolidation here, but the trend is up. It's got some very positive tailwinds that's going to support it. And once we do find a bottom right here, which again, this is looking like a higher low relative to this right here. Once we find a bottom, Tesla probably goes higher to the $350, $400 mark into 2025. So look at the names that are working, and that is US large caps, the S&P 500, the NASDAQ 100, the RTY. These are names that are working. These are names you want to be in. Look at the RSP. Don't try and bottom tick, guys. Ride the momentum trade we have from now up until the end of the year. And from there, we'll talk about material downside. There will be a massive pullback at the start of 2025. A lot of the data points I'm looking at is telling me that right now. And so we do also want to prepare for that. So at the same time you're doing this, you're putting cash to work. Don't forget, take profits. It's healthy to take profits and also build your cash pile, because there will be plenty of opportunities in 2025, but it's also going to be a really hard year to make money. The third year of the bull market is the hardest year to make money in a bull market. And that's what we're going into 2025. But in the year right now, buy the dip, ride the trend, don't trip. And let's dive into sentiment. This is the fear and greed index. And right now, greed is driving the market. Are we surprised? No, we're not. The market price action has been bullish. And that is because sentiment has been greedy. However, what is surprising is that we're not like in extreme greed. So based on sentiment, this market still has room to run. However, sentiment amongst institutions getting very, very frothy. Guys, look at this. The first 7,000 price targets are on deck. Deutsche Bank and Yardeni Research looking at 7,000 price targets for 2025. And we see BMO Capital at 6,700, RBC at 6,600. Very bullish price targets into 2025. And this is what's kind of worrying, because every analyst coming into this year saw bearish price action. They were expecting 1 to 2% growth in the S&P 500. Now the market's expecting 10%. That is a little bit of a sign that we should be cautious. However, Wall Street see the market going higher, and that's because we've had 2 bullish years, particularly this year. It has been outstandingly bullish. If we actually look at the year-to-date returns, the worst performing sector, healthcare, 7.1%. Remove healthcare and every single sector has returned double digits this year. The best performing sector being financials, up 36.5%, followed by tech, comm services, utilities, and then the S&P 500 up 26.7%. When we look at the factor segments, year-to-date growth has really outperformed. It's really been a year for growth, up 30% year to date. And that really is driven by tech and comm services. We also have Blend, 26.7%, the second best performing factor segment, along with mid-cap growth. Actually, large Blend is in third place, mid-cap growth in second place. And this mostly has to do with, again, financials, utilities, and industrials. They are a part of the Blend and mid-cap growth segments right here. All in all, the worst performing sector year to date, small cap value, which again, you get a lot of like biotech names in there, material names in there, regional bank names in the small cap value space, still up double digits, 16%. Very, very strong momentum. And this momentum is driven by earnings. I showed you this over the last couple of days, guys. Earnings is handily beating, up nearly 9% when the expectation was 4.7%. And what we're seeing right now is continued bullish momentum backed by fundamentals. And now even the commodity markets telling us we could really be in for risk on. The copper to gold ratio is a key indicator of economic health and is used to predict the 10-year US Treasury yield. is calculated by dividing the price of copper by the price of gold, and a rising ratio indicates that copper is outperforming gold, which could mean increased demand for industrial metals and a positive outlook for the economy. A falling ratio indicates that gold is outperforming and that investors are going to safety. And right now we saw the biggest uptick in the copper to gold ratio in the last year, telling us that investors are getting increasingly more risk on. Yes, that had to do with falling gold prices and some of the geopolitical tensions from yesterday. However, what we're seeing is a massive uptick here, and that is risk on fever. It's an indicator of the economy. And what also supports the rally right now is seasonality. S&P 500 is now in this tailwind zone where we should see upward momentum in the last couple of days in the month of November. And further to add to that, small caps normally bottom around this period of the year, and then we go on a very solid 3-month rally ending sort of mid-Feb, early March right here where we do pull back. So guys, the place to be right now, higher beta, cyclicals, growth based on the seasonality, the fundamentals, and the technicals, we should go higher into the end of the year. And diving into the macro, guys, we're going to take a look at the consumer and inflation today. And this is a chart we got from JP Morgan. And what we've seen over the last couple of years is cooling spending during this holiday period, November and December. This is the forecast. These yellow lines are the actual figures. And as you can see, we are forecast to see a 3% holiday spending increase from the year prior. The average from 2010 to 2019 was 3.6%. And while holiday spending is cooling, it's not something that's disastrous. We're sort of just reverting back to the mean, but still all in all, relative robust holiday spending growth year over year. And looking at the inflation picture, with the labor market back in balance, wage growth falling, and inflation expectations back to the normal, the fundamental drivers are in place for inflation to continue trending back to the 2% target. You can see monthly wage surveys right here, the employment cost index, and average hourly earnings. While we did see an uptick, yes, everything is pointing to the fact that we probably do trend towards our 2% target into 2025. At the same time, most of the offshoot or most of the uptick we've seen in inflation over the last couple of months reflects the lag catch-up effects that should continue to fade naturally as the catch-up is now nearly complete. In other words, we should continue to see inflation trending downwards in 2025. However, there are still risks to this market, the biggest one being tariffs, and it could really increase consumer prices. And how do we know this? Because it did so in 2018. PCE prices across 9 tariff-impacted categories saw consumer prices for tariff goods increase significantly compared to all other core goods, which saw a continued decline. So all in all, you should expect massive tariffs to increase prices. However, based on the newest Treasury Secretary pick, I don't think we're going to see these massive tariffs that the market is expecting. Maybe something more moderate. We definitely will get tariffs, but not some outlandish Make America Great tariffs that Trump was talking about all pre-election season. Diving into the earnings, we had a huge day of earnings today, and that's really it for the week. We don't really have much of anything else. A couple of big names next week, but Q3 earnings season is pretty much done. We've had a very, very solid earnings season, guys. And now we should start looking to Q4. But in the year and now, we need to look at the data. And tomorrow we have the core PCE, durable goods, the GDP growth rate, and then personal income outlays. Now, the consensus expectations for core PCE is to come in at 0.3, durable goods at 0.1. The GDP growth revisions, this is very interesting. We previously had 3%. The market is expecting a downward revision to 2.8%. That's very interesting. If we actually get a number that beats this figure right here, huge. That's going to be huge. And then personal income outlays of 0.3 and 0.4% for personal spending month over month. So guys, these are the numbers we really want to beat, but particularly this inflation number, especially with what we've seen with rates, the economy, the Trump trade. We need inflation to continue lower. That's going to really bolster the rally into the end of the year. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.